Good morning. Today we're going to cover a topic that seems to be of interest to a lot of vegans, which is how can I make some money investing in these vegan startups? Like, sure, it's cool, but how does it work? And today we're going to get right into that. Now, I'm assuming just a small amount of understanding already. Maybe you've got some money in the stock market. And so, a lot of people have at least touched what I call retail investing, the kind of investment offers that are generally available to the public. And that's the stuff that trades on the big stock exchanges. And so since most people have some familiarity with that, we're going to start by looking at how that works. And then after that, we can now go into what's different about investing in startups. Because everything that's on the big exchanges was one time a startup. And, we talk about people don't know where their food comes from. If they only knew where their, if they only knew how, animal, how do you call it food, but stuff that you eat made out of, stuff that people eat made out of animals, where does that come from? If people really knew how that was produced, they would probably never want to buy it. Now, that's not the same with stocks. Fortunately, when you know how it's produced, that gives you a lot of power and understanding. So let's start with the end product, some stock that's trading on Wall Street. And you've got really two things that matter about making money. One is the value of the asset. And so you might call that your principal or your basis. And then you've got the returns. And now even Wall Street, even understanding how regular stocks work, I've had so many of these conversations. There's a little bit of complexity there, so I'm going to make it even simpler. And so let's take something really mundane like a certificate of deposit in a bank. And when I was a kid, sometimes those things would pay 10% interest, so that's the return on the investment every year. These days, it's pretty hard to find a bank account that pays any more than 1 or 2% interest, like a long-term certificate of deposit. So let's take a look at that. Let's use 2% as our return on investment for a $1,000 certificate of deposit. And we're going to get a little geeky here, but again, I've had so many of these conversations. This is about as simple an explanation as I think you're going to get. So if at 2% interest, a $1,000 CD is going to pay $20 of interest a year. All right, so we got that basic math down. I mean, a lot of this is a math problem. If you're successful in investing purely with your heart, call me. You can advise me, but I like to know the math as well. I'm definitely very heart-centric when it comes to this, but I like to know the math. Okay, so we've got a $1,000 basis, and it's paying $20 a year, and how investors look at that is something called the price-to-earnings ratio. So the price of that investment was $1,000, and the earnings is 2%, so that is a 50 times price-to-earning ratio. And so that gives a measure. The price-to-earnings ratio gives a measure. It's one kind of ruler or yardstick used to help assess the valuation of something. And you'll find that kind of number, it might be called different things in different investing fields like real estate, but pretty much everybody is looking at that, some kind of multiple. What do I have to pay to buy into that cash flow? That is really what capitalism is all about. It's built on the idea, first of all, money itself is an idea, and then the idea of capitalism is that if somebody has a flow of money and they want to sell that flow, there's a price to that. Like the market decides that there's a value in that cash flow and people are willing to pay money to get access to that cash flow. So again, we looked at that certificate of deposit that's got a 50 times price to earning ratio. If you go look at a stock chart for a company like Apple, right now that company is trading at about 15 times price to earnings ratio. So that means that the value of all the stock in Apple is only worth 15 times its earning, whereas your certificate of deposit is worth 50 times what it's earning. So why is the CD valued so much higher than Apple in its price to earnings ratio? And there's a reason, because the reason is that it is safer, or it's perceived as safer. So let's look at the risks of a CD. So the CD is, we'll just use dollars. I know people are watching this from all over the world, but I'm an American and we think in dollars. So I'm sure you're used to that by now, sorry. Anyway, so why is it considered low risk? Well, the banks may have a fairly long track record of not losing money. Then there may be government insurance. But there's always the risk of currency, inflation, which reduces the buying power of the currency. So the CD is a place to hold money. Will it outperform inflation? That's a risk. Even though you might be making your 2%, if inflation is 5%, you're losing buying power. You're not losing dollar denominations, but those dollars are becoming progressively worth less when it comes to the future. And of course, taken very narrowly, the purpose of all investing is that you put money someplace in the hopes of having more later. But you don't just want more dollars, you want more buying power. And so those are some of the kinds of risks, but relatively the risks are low, but it's not risk-free. Banks fail, governments fail, but those risks, given all the other kinds of risks out there in investing, are considered more minor. So that's why an investment in a certificate of deposit is a premium over, say, investing in the stock market. Now, the stock market itself, sometimes the stock market as a whole gets highly valued. Everything gets bid up. And certainly during the dot-com bubble in the early 2000s, price to earnings ratios of 100 were common. And you have to look at that. It's like, because there's more risk, there's more downside risk on your principal in the stock market than there is in a certificate of deposit. And in general, the bigger companies that are trading on Wall Street, they have less downside risks than a startup, but there are downside risks, and sometimes they actually do go completely broke. And stockbrokers like to perpetuate a myth that the market always goes up. Well, maybe the market as a whole, which is why, first of all, always is just, that's not true. It does go down sometimes, but even after the 2008 bust, I guess you could say, things did recover as a whole, but there were individual companies that went completely bankrupt during that time. So if you invested in the Standard & Poor's 500 index, your losses might have been moderated. So I don't want to get too far into that. I'm just saying that basically when you're investing in an individual company, now you've got this new risk that the asset value of that company can decline, and it can decline all the way to zero, even the companies that trade on Wall Street. So let's say you're hoping to make 5% returns on Wall Street as opposed to the 2% in the CD, right? You want to make more money, but the risk is higher. And so here, you're really putting $100 at risk to make $5. All of the money that you put in any kind of investment, it's always 100% at risk. It's just the question is, how likely is that risk going to materialize? And during 2008, that risk materialized for a lot of people. And so now you're starting to get a sense of how these things are valued. So in general, the larger the company gets, so now we're going to start talking about how people make money by investing in startups. So a startup, and actually before I go into that, let's just say the price to buy a CD, when you look at it in price to earnings ratio, is high compared to buying stocks traded on Wall Street. They're lower. Now when you buy into a startup, well, it may not be earning anything. We're going to look at that separately, but let's say the company is making some money, and depending on the business and the growth potential, but in general, early stage companies are valued, or small companies are valued at a very low multiple compared to the large companies because they're just higher risk. And I used to go to all these alternative investment conferences that were aimed at the pension funds and ultra high net worth individual family offices, and I learned all kinds of interesting strategies from going to these things because I wanted to learn those strategies. I couldn't invest that way, but I wanted to figure out how to design investment products that could be used to solve important environmental and social issues. And so one guy that I really enjoyed his talk, he said, well, if a company's earning $2 million a year, or $2 million in revenue, that's not profits, just a company that's earning $2 million in gross sales, maybe that's only valued at about 2 times gross. And he said if at 5 million, if you have a bigger company at 5 million, then there's just a more bigger market. They bid the price up, so that might be worth 5 times gross sales. And he said a $10 million company making 10 million in sales a year, is worth 10 times. So what his whole investment strategy was, he would go and find companies for sale, small companies where the founder wanted to quit, that he could buy at 2 times gross, and he would just screw them together. It didn't matter. Like one of the company examples he had, I think he combined like a porta potty company with a company that serviced printers. It just didn't matter what they made. And simply by combining those companies so that their total cash flow was 10 million, he was able to make a 5 times increase in the valuation, and then he would sell that company, that new company. And so by doing that, he was able to return in the neighborhood of a 500% return on investment over the course of a couple of years to investors. And that little story gives you some real insight into what you're doing when you buy into an early stage company, because you're buying at a low valuation and you're hoping that the company grows, and the bigger and bigger it gets, the higher the valuation, the higher the ratio between the price of the company to its earnings. So that is the real essence of how you make money from investing in startups, is you're buying at a price. See, when people think of buying at price, they often say, well, the stock was, like Tesla. Tesla was at, $350 a share, and then it went down to $180 a share. So the price is lower. That is a trivial understanding of price when it comes to investing. What you're wanting to look at is the price relative to the earnings potential. And so That's the real value. In fact, I want to take a little aside because Warren Buffett is famous for being a value investor, and people often talk about him as the world's richest person that made his money investing in stocks. And he definitely is a value investor, and what I'm really talking about is value investing. But Warren Buffett didn't make billions of dollars by buying stocks on Wall Street for himself. He made billions of dollars buying stocks on Wall Street for other people. And so by applying the value investing principles of a guy named Benjamin Graham, and you can read his book, Warren Buffett could outperform most average investors by a few percentage points. And so he started on this path to billionaire-dom in Omaha by going to all the doctors who were completely hands-off of the management of their retirement portfolios. And you just said, look, you're making 5% a year, I can make you 8 or 10. And so he aggregated, they said, okay, fine, we'll give you a chance to do that. And, he was fresh out of MBA school and had studied, all this good stuff and was pretty good at his own portfolio. And so it was by making a tiny, a percentage here and there of other people's money, that's how he got to be a billionaire. And investing well. I don't want to take anything away from his investing skill in that narrow context of just making money. I never wanted to do that because to me investing in Coke is like a sin, and he likes Coke and McDonald's. And so my whole life I've been looking for how to invest in a way that matches ethics. I started this journey back early on when I was in high school because my grandmother gave me $12,000 for college, and I don't want to go in the whole story out. That'll be another video, but that was when I started looking because the portfolio she gave me, I don't know if there was Texaco. It was full of oil companies, and it's like, these are the guys destroying the planet, and I was an environmentalist already by then. And I kept looking, it's like, where are investments that match what I care about? And then I started finding some solar energy stocks, and then I invested in, those went broke really quick. And again, that's his topic for another video, but pretty soon I had chewed through the 12,000 trying to find ethical investments that I could buy on Wall Street. So people want to know, like, how do I know what I'm doing? It's because I've been trying, I've been at this for a long time. You can see I'm not a kid anymore, and we're talking about the 1970s is when I started looking at how to align my investing with my values and my environmental and social values, which were, of course, out of step with the mainstream culture at that time. And it's been a long journey. It's been a long, long journey because the stock market, look, even beyond me, it is 10 years old. The big stock market is a snapshot of old values. Many of the companies on Wall Street have been trading for 100 years now. General Electric was formed in 1904. So when you buy into Wall Street companies, you're buying very old value sets for the most part. And when you're buying into startups, especially vegan startups, you're right on the bleeding edge, as they like to say, the cutting edge. I guess the cutting edge is the bleeding edge of the future, which is why this is so important. So, okay, so now we've understood that even in a certificate of deposit, the risk of loss is 100%. And the risk of loss on Wall Street, publicly traded stocks, is 100%. So when you buy that CD, you're risking 100% to make 2. That's putting $100 at risk to make 2. On Wall Street, you're putting typically $100 at risk to make $5. Maybe a little more. Maybe you're putting $100 at risk to make 10 in a year. Now, when you go into early stage companies, the risk and reward it gets flipped. Now you're putting $5 or $10 at risk to make 100 or more. If we look at the early investors in Uber, those guys are pretty lucky. They made 20,000 times. So they put $1 at risk to make $20,000 over 10 years. Right? That's exactly the opposite of what you do when you're buying stocks on Wall Street. And again, as in our last video, we discussed even the early investors in Beyond Meat. Surely, I don't have the exact numbers, I'm trying to get them for you, but surely they've made at least $2,500 for each dollar. So investing $1 to make $2,500. Now that's lovely. Let's all get rich doing that, but there's some problems there. The risk of losing all of your money is still there. There's still 100% potential for loss. And the risk of that loss is higher. So if we go, the risk of loss in a CD is maybe the lowest. The risk of loss trading on Wall Street is moderate, which is why I call Wall Street investing low risk, low return. The CD is super low risk and super low return. And investing in early stage companies is high risk, high return. So the way that you stay out of trouble is, first of all, they're getting some sensitivity about entrepreneurship. That's something that our investor members they're getting. They're starting to learn how to, what are some of the success factors of environmental leadership and building a company that makes sales and grows. So that's a factor. Another way is diversifying your risk, so not putting all of your money into one company. And that's another service that Vegan Lunch really provides to investors, because by ending the scarcity of investment opportunities, now you can invest in high risk, high return opportunities in a diversified portfolio and not putting too much of any of your money into any one company. So now you're having a sense of how you make money. And one of the challenges, I'll just touch on this now. Again, we discussed how Uber, 9 years before the early investors have even a chance to convert their holdings into cash. And similarly, 9 or 10 years with Beyond Meat for the first round investors. The later round, here's another interesting thing. See, Uber's gone through many private rounds before they went public, same with Beyond Meat. Each of those rounds, you could say the investors paid a higher price. They bought in at a higher price to earnings ratio or a higher valuation. Some of the companies, we have to be careful when we talk about earnings with early stage companies. That's going to be a totally separate video. But the main principle, the main point is that as the company succeeds, it gets less risky, and as the risks reduce, the later investors pay more. So this starts from the very first round, typically through private rounds, and then finally, the IPO is the highest price after all those private rounds, and then the company is trading publicly. And again, we're not even going to talk about that story. There's so much discussion on, you could find thousands of videos on how to value publicly traded stocks, but very few on how to value startups, because it's just been the domain of the highest, the top of the wealth class of the world and pension funds. So people have not had this knowledge taught to them. But now, with the various reforms in our financial laws, the general public is having, again, progressively more and more opportunities to invest in startups, and this education is vital. So I think that's it for now. Post any questions below. That'll be good for helping understand what you want to learn. And if you like these kind of videos, be sure to subscribe and hit the bell if you want to get a reminder every time I post a new video. So thanks for watching, and I'll see you in the next video.